Well, we're halfway through the year and market is sending mixed signals. Are we headed for a soft landing or even more uncertainty? And what's the role of commodities in the investing landscape? Welcome to the second episode of TDAM Talk's mid-year outlook. In our first episode, we dove deep on the equity market, and today we're going to pull the lens back a little bit and look at the asset allocation landscape across asset classes. And we're going to also take a deep dive on what role commodities have been playing. As we did in our first podcast, we're going to look backwards over the last 6 months. We're going to take a look at the back half of the year and what we're expecting. Joining me today is a podcast favorite, Michael Craig, head of our asset allocation team, managing over $100 billion in assets for our clients. And joining us also, our guest, Humza Hussain, from our commodities team to tell us just how commodities will play a role in this landscape. Gentlemen, welcome.
Thank you.
So we're going to take the same format I did with our equities team. I'm going to start with you, Michael. Let's talk about the first 6 months of the year. Was it as you expected? What surprised you the most?
Well, it wasn't as we expected. And I think part of that is just we had a policy error April 2nd. From our conversations, half the administration wanted to start. We knew tariffs were coming. Half the administration was moving towards a start slow and ramp up in terms of trying to get countries to adjust behaviors. But that side didn't win. It was more the economic nationalist side, Pierre Navarro, Lutnick, who pushed for the kind of big bang approach. Candidly, the administration probably lost a month as they tried to have to unwind the chaos that created, both in the markets, trade flows, the looming shortages that were going to hit U.S. shelves quite rapidly. And I think we're back now to where we thought we'd be, and that is tariff policy will probably come in somewhat like a sales tax, 10 to 13% higher for China. And the administration will start to focus on its other goals in the back half of the year. So a lot of volatility in the first half. The markets have reacted both negatively and positively as we walk back the kind of extreme tariff policy. I think the tariff story is probably in the latter, if not ninth inning. I think we're getting to a point where we have some degree of where we know we're going. But that now leads us into what we think on the second half. The other thing, not surprise to us, is that the dollar has been soft, and I think this is more of a trend than just a trade, in a sense that the world's behaviors are going to lead to changes in investment policy, changes in government policy, and I think that will lead to stronger growth, relatively speaking, to the versus the U.S. and lead to a weaker dollar.
Yeah. Great call out on that. And for our listeners, we do have our recent Global World Order podcast where we did highlight the portend the weakness of the U.S. dollar. And what about the fixed income landscape in the first half of the year rates?
Bond returns are give or take 1% now. Credit was repriced negatively and then has come back. Rates have been modestly higher. Really, the U.S. story has pulled up the rest of the market, but net, a mediocre start to the year, clipping at 1% total return, although relative to U.S. equities and Canadian dollars, not horrible. And so not a great start to the year, but not a terribly horrible one either. Just kind of mediocre.
Humza, I'll turn the question to you. We've seen a lot of activity on the commodity front in the first half of the year, gold, energy prices. Talk a little bit about that.
So I think the bigger theme is that we are in we're at an interesting juncture for commodities. I think today you would look at commodities and say it has a lot of tailwinds. The first one I would describe as internal to commodities, and that's the traditional kind of business cycle in commodities, which is because of how long it takes to bring supply online. It's like a very long 30-year cycle. And so it's a traditional cycle where you go through a period where you have high prices. High prices encourages investment. Investment encourages oversupply. Then you have oversupply, which causes low prices, and so on. And so if you look back at the decade prior to COVID, that was definitely a period of underinvestment. And so now we are going to reap the effect of underinvesting in commodities over the prior decade. And so commodities are tight, inventories balances are tight, and we see that sustaining for the next 10 to 15 years. I think the second set of tailwinds are all the big themes that are kind of capturing headlines right now. All that investment in energy we need to make for AI, decarbonization, electrification, all those big themes in terms of supply chains, in terms of manufacturing, reshoring, friendshoring, nearshoring. And then there's also rearming, reindustrialization. And related to that, I think we're on the precipice of kind of the largest global fiscal expansion we've seen in probably 50 years since World War II. If you look at US, they've been running 5 to 10% deficits for the last 10 years and will probably continue to do so for the next 10 years. Think about Europe and their $800 billion plan that they've announced. Think about Germany, who are kind of very traditional fiscal stalwarts, changing their rules so that they can do a 500 billion rearming, reindustrializing program. Think about China. 2025 is probably the year they run the biggest fiscal deficit over the last 10 years. And so that also helps commodities on both ends, because these are not monetary policies. These are fiscal, industrial, manufacturing driven policies. And so that'll support commodities on the demand side for materials and energy. But if you think about how they're doing it, they're running fiscal deficits. They're effectively printing money. So you're debasing currency. And in that kind of an environment, you want real assets, and gold and commodities are the realest of assets, right? And then on that last part, on geopolitics, I think we're moving into a world that is increasingly becoming more chaotic. And I think the best way to express a long chaos position is through commodities.
And through gold, as we talked about, we met in the fall just before Christmas for our listeners. We have a commodities podcast, and really what we've seen in the first half of 2025 was exactly the landscape that you talked about. So really great call it. Okay, well, looking back is the easy part, gentlemen. Let's look forward to the last half of the year, the back half of the year. What are we expecting?
So we'll start with the U.S. Midterms are rapidly approaching in 26. The last thing the Americans want is any type of recession going to that, because that will lead to not a good result for them, the current government in the midterms. I think deregulation is going to be a top priority this fall, particularly with respect to financials, energy, general investment in general. I think a lot of the environmental constraints will be lifted, and that will lead to probably a stronger growth in 26. Again, I think we're going to go into a soft patch this fall, and that's not neither here nor there, but broadly speaking, stronger growth in 26. In the non kind of U.S. sphere, Western sphere, American policy has ironically, make America great again has actually led to make the world great again, in the sense that we're moving towards countries focusing on self-sufficiency, taking care of their own defense policy, driving aggregate demand higher. Many economic models that countries have been following have been driven by exports growing faster than imports, exports going to the U.S. consumer. Recognizing that might not be the most attractive mode of growth, I think you'll see countries really focus on consumption and investment depending on their mix. That will lead to higher nominal growth. And our work empirically shows a very, very strong relationship between nominal growth and top line revenue for companies. And so we would expect to see revenues grow far faster than trend in the coming years with this fiscal expansion. It's going to come at a cost. We're going to spend more money than we're taking in. But growing your debt isn't the worst thing if your GDP is growing at a faster clip. That's very sustainable. So think about, when you start out just after the university, you don't qualify for a large mortgage because you have no work history. But as you work and as you build your human capital, as you gain assets, your capacity to increase your debt or lever your balance sheet increases. And so a similar way to think about countries that, yes, they're going to be spending money, but what's that money being spent on? If it's being spent on redistributive policies, you get Argentina or Venezuela. But if it's spent on assets that create growth or create real or increase the potential growth, those are good investments. Where it becomes cloudy is what's going to be the efficacy of that investment. So that's where we're spending our energy is, are these investments, do they make sense? Are they going to lead to stronger growth? But our sense is for the second half of the year, the stock market should do okay. We're honestly bullish right now on equities. Where I do see some, not so much risk, but just I think the capital gain story is over is in fixed income. The demand for capital is going to increase, as Humza just said. The world now is looking at starting to soak up their excess savings for their domestic priorities. And overall, this will lead to long-term bond yields being higher. than perhaps where they are today. I think the U.S. is probably somewhat priced for that. Canada is not. So I wouldn't be surprised to see Canadian rates drift higher. That'll be a headwind to fixed income, but the yield you're getting now is far higher than it was 10 years ago. I mean, our yield levels are just under 5%. So that'll make up for it. But, from an investment backdrop, outside of the kind of crazy events like we've just seen in the Middle East, the 12-day war, we should see a relatively strong equity market with pockets of higher volatility. And I think that overall volatility will be higher in the months and years to come.
And the role of commodities in the back half of the year specifically?
So I'm going to cheat a little bit, and instead of trying to make a call for the 6 months, I'm going to kind of focus more on the big themes. But I think the big themes that apply over the next 6 months are the same that are going to apply over the next 20, 30 years, right? And so my view is that the upcoming 20, 30 years are not going to look anything like the previous 20 to 30 years, right? And I think a lot of people who have built these models, these mental frameworks of how the world works, how economy works, how government politics work, are going to be constantly find themselves surprised and wrong. And so, if you think about the last 20, 30 years and we kind of simplify it and distill it down to a few kind of big themes, it's, U.S. hegemony, dollar is king, global rates making a beeline to zero, and trade was so frictionless that essentially the developed world was happy to outsource all their manufacturing, their security, and their energy needs. And I think all those forces are now either receding or in full reverse, right? And so for us, how, we have to think about that when it comes to portfolio construction. And so we have to think about, how do we build a better, more durable portfolio in a world where the volatility of everything is higher, right? The volatility of interest rates, of inflation, of policy, of geopolitics. How do we make a stronger, better, more diversified portfolio in a world where bonds and equities are positively correlated, right? And that's where commodities come in. Because I think commodities will thrive in a world where you have increased volatility of everything. And we've seen that over the last 5 years.
And sometimes, I'll meet with clients. They'll be like, well, what are you investing in now? And we always are making kind of the marginal dollars to where we think the most attractive investment opportunity is. But the secret to long-term success is understanding a client's risk preference and then building a portfolio that is able to accrue the highest amount of return for that risk preference. And the secret with commodities, just to pick up on what Humza said, is that it behaves quite differently than stocks and bonds. The reason we use infrastructure or real estate, it behaves quite differently than stocks and bonds. And so as a result, we're able to actually engineer, or the goal is to engineer portfolios that are able to achieve a higher level of return per unit of risk because we've optimized our diversification. This past little while, today commodities are selling off because we've got a ceasefire. Going into the last week, when stocks and bonds were struggling a bit, commodities rallied. And that's kind of a microcosm of what we're trying to achieve. And that is far more diversified portfolios, similar levels of risk, but the outcome is an expected higher level of return. And that's where the engineering and the more the science of what we do comes into play, and looking for what is the investment we don't have today that's going to make our portfolios better. And that was really the genesis behind why we built out a commodities group. One of the few in Canada to actually do that for clients, and so far it's been very good. I think I would just say a big chunk of the commodity return comes from the yield it accrues from the collateral. So when Humza takes in $1, they buy short-term T-bills, and then they use derivatives to get their commodity exposure. So ironically, the yield of the commodity portfolio is 5%, 5.5%. So we know on any given year this is where we're starting at. And while we might see a bit of interest rate cuts, maybe one or two more in Canada, maybe one or two in the U.S., there is a body of central bankers who actually don't want to cut rates. So we might see a little bit of headwind on rates, but actually as the world starts to accelerate again, overnight rates should rise in tandem with that. And that actually is a cruise to a benefit, more return in the commodity strategy.
It's great. Our first mid-year outlook podcast, we talked about equities, and the outlook was positive. I'm getting a similar theme here, and the theme that I'm really taking away from our conversation is the power of the diversification, the added secret sauce of commodities, and the real resilience focus in the portfolio construction. I'm going to ask you the same question I asked our equity team, and I'm going to ask in our future podcasts. What's that one thing in the back half of 25 that people aren't thinking about?
Yeah, so I think the possible surprise in the back half will be debt swaps. So this is more of a, it might happen, might not, but I know there is a push to make it happen. And what I mean by that is there's trillions of dollars of U.S. bonds floating around reserve managers' balance sheets in the world, particularly in Asian countries. And the U.S. is looking at this, and the challenge is you constantly have to refinance. It creates codependence. Those countries will also rely on the U.S. consumer, and they also rely on the U.S. military. So you can all these things now are in the same package. And from our conversations, there's active negotiations to term that out, to swap that short-term debt for century bonds, non-marketable securities. This is going to take a lot of pressure off the front end of the U.S. Bond market. These bonds will be taken off the market. They'll just hold them. They'll still be used. They'll be fully fungible, so they'll be able to be used as collateral. So from the reserve manager's point of view, you're taking a 4-year bond and you're turning it into 100. So maybe you're not so happy about that. But if it means that's where you're going to get military security, you'll take that. This would be likely a dollar negative. It would be a bond market positive. So something that I don't think anyone's really thinking about. But from our conversations, it is, once we get through kind of the current chaos in the Middle East, it is an active negotiation and something to be mindful of as a potential shock and to markets. Shock in a sense, it would be dollar negative, bond positive, and probably equity positive.
So much ground we've covered, gentlemen. Thank you so much. That is a wrap on our second episode of our mid-year update series. Going forward, we will be touching base on fixed income, and following that, we'll be delivering you a podcast on real assets. Thank you again, gentlemen, for a great conversation, and to our listeners, make sure if you haven't already listened to our summer series on equities, that is loaded. You can get it where you listen to your podcasts. Thanks and have a great day.